I'm a professional investor competing in the US Investing Championship for 2026. My account is up 42% for the year so far. It's January 23rd. Every single trade has been put on live on YouTube and is linked down below in a Google Drive sheet. Now, with that out of the way, what I want to do is talk about why it's important that we look at the market. Because in a nutshell, the way that I was taught is that 40% of every stock's move is due to the market. 30% of every stock's move is due to the sector, and only the last 30% of every stock's move is due to the stock itself. So let's jump in and explore that concept just for a minute, because one of our outliers, this was Brian, had this great question. Why is the SPY such an integral part of entry signals? So what I want to do is jump into one of the trades that we have on right now, like KGC. And let's look at KGC. So KGC is in the materials sector. Now, as of today, we can look over here in the outlier 9. This has the market, this has the sector, this has the stock, right? As of right now, this is 7 of 9. We want to have everything lit up. We want a 9 of 9. That creates a effortless trading environment, and we don't have that right now. The thing that we don't have right now is a buy signal on the market. You can see the SPY is still sitting on a sell. Now, when we're looking at this, if the stock is set up, but it's in a poor sector, right? Think of it this way. Let's work backwards here. If you've got the best performing stock you've ever come across, yet the sector is getting weighed down. So let's say, for example, you're looking at the finance sector, right? Let's use SoFi. SoFi, greatest stock in the history of mankind, right? Will only go up ever, period, full stop. Mark my words, only goes up. I'm being sarcastic here because SoFi bros are absolutely unreasonable. SoFi's going to go up. SoFi's trending up. SoFi's got a buy signal. It's getting more greedy. There's no outlier blocks in the way. SoFi looks incredible. But what about the financial sector, right? How about the whole sector just got hit with some bad news, right? I actually am a real finance bro. I worked in finance for 17 years from 2008 until today, because I'm still working in the finance sector. How many years is that? No, 2009. That's right. 2009, February of 2009. That would make 17 years. And let's say the finance sector gets rocked with some news, right? Maybe interest rates get absolutely monkey hammered, and at the same time, delinquencies spike like crazy. And Trump comes in and he's like 10% cap on credit cards, period, and a 2.5% cap on any other loan other than credit cards. The finance sector would get absolutely ruined. Reason being is delinquencies are basically losses on every loan that they lien out. They need to make a spread, right? So if they loan you money at 5%, they are able to get that money for a lower rate than 5%. Let's say they take it from their depositors for 5 basis points, which is 0.05%. They get to keep the difference on that spread, right? That's how they make money. But if you collapse their spread, right? If you collapse their revenue and you expand their expenses, their losses in this case, the entire sector will get totally monkey hammered. So it doesn't matter how great of a stock the one stock is. If the whole sector is getting destroyed, your stock is not going to overcome that. Just not going to happen. Now, let's take it a step further, right? We talked about the stock. We talked about the sector. Let's think about the market. If the market is in a downtrend, you are now fighting headwinds of the sector working against you and the market working against you, right? Think of it this way. If a rising tide lifts all ships, a falling tide shows who's swimming naked. That's a little adage there. But it just makes life easier when your stock, your sector, and the market are all moving in the same direction. It honestly makes trading feel effortless, right? Everybody feels like a genius in a bull market. Why it's so important is because, in fact, we backtested this while we were working on Plan M, which has printed so much money for us. We were looking at different scenarios, and one scenario that Scott presented to me, I like to look at not just the outputs, right, like the average win, average loss, win rate, etc. But I actually like to go and look at the data. Once all the programs are run and the output gets spit out, I actually like to go look at the data. And what I noticed was there was a huge clump of losers in this particular scenario. It was 140 losers in a row. And I texted Scott and I'm like, something's not right here. Why would we have 140 losers in a row? Guess what the market was doing during that time? The market was in a downtrend. And the buy signals were not buy to go long. It was buy to cover your short. Okay. So in a nutshell, you want to be going with the market, with the sector, when the stock is going that direction. If any one of those three items are not in sync, you don't need to trade. I know it sounds crazy, but Chris, if you're a real trader, then Chris James would say something like that. If you're a real trader, then you'd know you got to trade all the time. BS, right? Sitting in cash and not effing up your portfolio is a core tenet of successful traders, right? What does this mean? You want to sit in a cash vehicle, whatever that cash vehicle is, and it could be SGov, something that pays you money with zero market risk. And then you don't want to F up your portfolio because you're like, you have the Chris James mentality, which is, I got to go out and invest in something. I better go invest in SoFi right now while the market's crashing. And then your account gets, as you call it, effed up. So great question to kick this off. We have 40 questions highlighted right now. I'm going to try and run through as many as I can. Okay, I didn't expect this. How does it feel to be so awesome at teaching people how to be winners and all? It's great right now, but remember, we will have losers later. Winning is an unavoidable, inevitable part of trading. It is a fact. Winning is an unavoidable, inevitable part of trading. But losing is also an unavoidable, inevitable part of trading. You have to understand, we want to make our winners run out of control and cut our losers short. Right now, we happen to hit a great winning streak, but here's where a lot of people F up. In fact, I actually had a conversation with one of our Outlier University students specifically about this. He has had incredible gains this year. At this point in time is where people start screwing up because they get overconfident. They start to oversize their trades. Maybe they were risking 1% of their trades, maybe 2%, maybe 3%. And they're like, well, Chris trades a lot more than that. Maybe I should go higher. And then what will happen, because it happened before, is the very first trade where you size up, that's your losing trade. It wipes out all the gains from all previous trades because you sized up thinking you were ready for it. Okay. Just because you're on a winning streak does not mean that these trades that have been winners will have any sort of bearing on any future trades. So here is the real crux of it, right? Every trade is a unique circumstance. We happen to stumble upon a fantastic set of variables that all worked for us, but it always fit inside the data in the plan that we were going to take. Every trade in the future should also always fit in those variables, but we don't know what the outcomes will be. So as much as I'd say, I'm a genius, I can't say that because this is the point right here. This is the turning point where people start screwing things up. I don't want that to happen to you. Have a plan, maintain that plan. Don't change the plan, even if you just came off a winning streak. Outlier McDuck, as you roll up your option trades and they increase in value, how do you manage your stop loss? The 2 ATR seems to get pretty far away. It does, right? Stop loss is there for the purpose of stopping your loss, right? In this case, we are managing gains, right? So first, by rolling, in fact, let's go to Portfolio Manager over here. By rolling, what we're doing is we're taking risk off the table, okay? Now, let's see, 84 plus 225 is really close. Let's see, 84 plus 225 is 309. So for KGC, I have rolled it twice already. On the first two rolls, 84 and 225, I've collected $3.09 of credit. My original position, let me make this bigger so you can see it. My original position cost me $3.50 in credit, okay? So even if KGC goes to zero tomorrow, the most risk I have in this trade is 41 cents, 350 minus 309, which means if we look at it, so 41 cents divided by 350 means I've taken off 89%. Let me just do this, minus one. Oh, come on. 41 divided by 350 minus one. There we go. I've taken off 88% of the risk in this trade. 88% of the risk is gone. The next time I roll this, which I don't know when that'll be, potentially today, I don't know, I will have absolutely zero risk in the trade. Zero risk in the trade whatsoever. So it can crash down to anything. And I will have no risk in the trade. Now, by doing that, I'm also protecting my profits. I'm taking partial profits on the way up. This is why we roll. We are protecting our account from any sort of pullback. We are taking those partial profits off the table now before anybody has a chance to take that money from us. We are taking the money and putting it in our bank account. What do we do with that? We could potentially put it out in new trades. We could put it in a interest-bearing cash account, or we could go to Costco and load up on groceries for the winter apocalypse. right? All of that can happen. So fantastic question. I don't worry about that because I'm rolling and my stops. In fact, let me pull this back up. My trailing stops move up along with me. So there's two different types of stops. Stop losses, which is where you're in a trade already and it just isn't going to work out, and that's fine, versus a trailing stop. So trailing stops would include the outlier sell signal and the 10-20 bearish cross, or even running into an outlier block. But your stop loss would be down here, the 2 ATR stop or 3 ATR midday emergency exit. Great questions, though. I love it. I want to do everything I can to help you guys be successful. Would you mind going again how you calculate rolls? I think I just did that. So basically, we can do it real quick. You take your initial amount paid. By the way, this exact spreadsheet with the exact trades that I put on this year in the US Investing Championship, which will be reflected at the end of the month. I'm going to email Norm Zada, who will be interviewed on this channel in the very near future. I email my statement to Norm. Norm will update the website, and you will see not only are we not full of baloney, but you will see these exact results of mine, as well as several other outliers, which I'm super excited about. But you put in the amount paid here. So for example, when I bought the 30 strike, the stock price was at 33.03. I paid $3.50 for the 30 strike. And now the 30 strike, even after I've rolled it I've rolled it from, 1, 2, 3 times. I don't know. Either way, every time you roll it, you put it up here. Yeah, I've rolled it twice, and this is what the current value is at. The current value is this, and I've rolled it once for 84, once for 225. That's how I do the calculations here. Next question. Your rule is to never roll for a debit. Okay, so before we go any further, right? If you roll for a credit, you're reducing risk, you're taking partial profits. If you roll for a debit, you are increasing risk and spending more on the trade. When you roll for a credit, you're reducing your risk and you're taking partial profits. When you roll for a debit, you are increasing risk and you're costing more in the trade. Does that make sense? Okay, now continue on with the question. What about when you're close to its close? How do you manage that? Oh, I got to roll for that. It's super easy. Once it gets within 1 week of expiration, 1 week before expiration, you ask yourself these questions. Am I already profitable in the trade? Yes. Can I roll for a credit? Yes. Roll it. Am I already profitable in the trade? No. Go ahead and close it. It's just not going to work out. Is it already profitable? Yes. Can I roll for a credit? No. Go ahead and close it out. Right. And the longer you watch, the more you'll see me do exactly this. Right. If I can roll for a credit, if I can reduce risk, take those partial profits, I'm going to do it. If I can't do it, unfortunately, it sucks, but it is also part of the game. You just got to get out. Would you educate me on the risks of buying 80 delta options on leveraged ETFs? For example, buying options on SPXL. I mean, here's the thing. When you're doing leverage on leverage, great things can happen. Honestly, great things can happen. But remember that leverage instruments are susceptible to what's called volatility drag. Now, I love trading. I love finance. I'm sure you guys have figured this out by now. So you may not have heard of volatility drag, but let me explain it. Volatility drag. The volatility drag looks like, let's see if I can find a good. Will this work? This will be fine. Imagine the green line right there is your index, okay? And it's moving up. It looks great. Oh, okay. So I should obviously be having returns like this. Well, not necessarily. If the down moves are also compounded at 3 times a leveraged ETF, as well as the up moves are compounded on a 3 times ETF, over time, because the way that math works, it will actually drift down. That's what's called the volatility drag. And that's why it looks like this. If they are not compounded, it'll look something like this, right? So volatility drag is a real thing. It is a real phenomena that impacts leveraged ETFs. And you will actually see leveraged ETFs do reverse splits because of this, right? It's going to go down and down and down. And at some point, it's going to get so cheap that they have to reverse split it to make it more expensive. So it can go down and down and down and down and down again, right? It is a real thing. So if you are actually buying calls on this and you're not aware of volatility drag and you're not aware of how to get in and out, you could actually watch your account blow up really fast. And I mean, can you do it? By all means, you can do it. Leverage on leverage could be amazing, but it also could backfire real hard. Cam, what's up, dude? Cam and I are going to work on a project here. I have just been super overwhelmed. Cam is amazing. Young gentleman who went to Texas Tech. When price enters the order block, we wait for a cross in the 1020 through the rest of the trade instead of selling when closing in the order block at the end of day. Ego. Okay. So this is one of those times. Let's talk about ego. Ego here. So ego has these order blocks right here. Okay. And I've told you all this many times before. Order blocks totally work. But also, if there are enough buy orders to chew through all these sell orders, what do you think is going to happen? It's eventually going to drift higher. And so for me, it wasn't a big deal. Right? It's not a big deal to go ahead and when you get your exit signals to close that trade. So for me, whenever it hits an order block and it does not cross in the 10 and 20 on the 5-minute chart, I just let it run all day. And then if it closes inside the order block, which is exactly what happened here, that's when I'll close it. But if it does cross at any point during the day, I will get out. Okay. In this case, it ran up and then it continued to run up and it's still running up, and that's fine. Right? For me, there is additional risk to run into an order block like this. A big, ugly, nasty order block just like this one has a lot of risk associated with it. As a risk first trader, when I see a wall of sell orders, which is exactly what this represents, I don't know how many buy orders it's going to take to overwhelm that. So I'm not going to risk it. I'm just going to get out of the way. But I mean, if Cam, if you come up with a plan and it involves order blocks, just be sure that it doesn't just work in this one instance, but it works on as many instances as you can and actually provides a higher expectancy. Steve, what's up, Steve? If a stock goes sideways for a few days and an order block appears, hang on. I think the SPY did exactly that. Yeah, SPY did exactly this. Okay. Would you treat it the same way as an order block you entered during the day? Not necessarily, right? Not necessarily. The way that I look at it like this, right? We have some criterias that we back tested. Now, of course, we have the data to back this up, but you may not. Okay, so come up with your own plan. But if there is an order block within 2% at any age on Plan M, I don't want to enter it. Plan M is our most aggressive plan. So here, if it's within 2%, which this is, where is it? 0.37% away, I wouldn't enter it today on Plan M because it is any age and it's within 2%. However, if we look on Plan ETF, which is a different plan, mechanically works different, mechanically is set up different. If it's within 2%, we want it to be at least 30 calendar days old to invalidate this thesis here. So this one is not 30 days old. So I would trade it using Plan ETF if it were set up for me. And that was the only thing we're talking about here, right? So of course, it really depends on your risk tolerance and it really depends on part of your trading plan. Have you found a good site for backtesting? So I used to use, now Steve Burns introduced me to the folks at TrendSpider. So I had a relationship with them for ages. And TrendSpider would let you backtest on every chart every time. And it was awesome. Now I've shifted over to TradingView mainly because you guys all use TradingView. And I wanted to make sure that what you saw was the same as what I had. Now TradingView has a free plan, which is fantastic. The free plan is honestly fantastic. And a lot of you just use that free plan. TrendSpider's plan was over $100 a month. So for a lot of people, it just didn't make any sense to do, especially when there's a free option versus a $100 a month option. So by doing so, I gave that up. Now, with that being said, I know DeepThought, aka Deep Pockets, is also working on that right now. So while I don't have a backtesting engine to give you at this moment, I'm sure if you Googled it up, you could probably find something that'll work. But we are trying actively right now to build a backtesting engine for you because that's our job at Outliers, to make things easier, right? Save time, make money, start winning with less risk. Please explain again why rolling reduces risk. By taking in credit, you're offsetting the original debit that you paid for it, right? So back over to here. By taking in 84 credit and a 225 in credit, I've offset the original 350 that I paid for it. I see how you remove profit from the trade. It's the same thing, but the value of the option can still fall below the entry. I mean, it can. Like the value of the option here could go to zero. It could, absolutely. Let's just theoretically do that, right? So in this case, my loss would be 697, which is however many contracts times the difference here, which is 41 cents. Because I've already taken 84, I've already taken 225. If the one that I've rolled to goes to zero, it's 11% loss. Had I not rolled and it goes to 0, that would be a 100% loss. Okay, so maybe that just clicked for you, right? By taking those partial profits now, that is offsetting my risk. If the one that I'm still in goes to 0, I lose 11%. Okay, no big deal. If I had not rolled at all and it goes to 0, I lose 100%. That's the difference in this case from $600 to nearly $6,000. Pretty cool, right? Pretty cool. That's why we roll. Right, we're taking risk off the table. In this case, I'm up 80% on that trade. Let's keep going. Brian, how to track drip in the portfolio manager? I mean, what kind of drip we talking about? We talking about like gold watches? Hold on, you made me do it. We talking about sparkly gold watch drip, right? Where it's all iced out? Are we talking about? I'm not going to go full Chris James. I won't go full Chris James. I won't do it. I promise I won't. You're talking about Cuban link kind of drip over here. Hang on. Here's one more I want to put on. The Panther. The Panther gets me so excited. I'm talking about sparkly chains with the Panther pendant, right? I don't know. What kind of drip you talking about, dude? Let's go drip. Oh, drip looks like the kind of stuff that was made with this coffee. I don't know what you mean by how to track drip in the portfolio manager. I guess I would track it like every other stock. Can option prices move differently from the underlying stock's price? Absolutely. So let me log into Tradier and we'll talk about that while I remove these absolutely obnoxious chains here. You know, you're not a real millionaire unless you dress like that, right? You're not a real millionaire unless you got at least 2 chains and 2 watches. Oh, you're right. Until that point. So I'll leave the watches on, but the chain's got to go. How do I get this thing off? Oh no, hang on. Oh, I was like, did the class break? That would be so messed up if the class happened to break right now. Okay, 2 watches though. Got to go 2 watches. Let's log in to the start live trading. So first, an option price is going to move very differently just from delta. What delta means is it's the change in the price of the option versus the change in the price of this stock. So like, for example, if you had a 20 delta option, it'll move 20 cents compared to what the underlying stock is doing. So like, let's say we're in KGC right here. If you bought the 20 delta option down here, this one, the 43s, it's going to move 20 cents every time the KGC price goes up $1, which is not great. I prefer to hang out in the 80 delta versus the 20 delta because this will move by 80 cents for every $1 move here. So that is one way the option price can disconnect. Also, what can happen is spreads. Spreads are effed up, right? You can get into this, and this is 70 cents. This is a 70-cent spread. This is a $1.50 spread. These spreads are out of control, right? This is nearly $1 spread. I don't want that. I don't want that at all because you have to pay the difference between buying and selling. And in this case, that may be, 70% of that price may be the difference between buying and selling. I don't want that. You don't want that, right? So that's another way that option prices can move differently from the underlying. It's because they're trying to give you the midpoint. And sometimes if the spread's really wide, the midpoint's going to be all over the place, right? That especially happens on weekends or on a volatile stock. You see a stock that's popped up 10% in a day, which does happened to us yesterday, and it was glorious on PPTA. In fact, let's go to that real quick. So PPTA is a stock that we were in yesterday, right? Popped up 10%, nearly 11% on the day. That will cause the option prices to kind of go wild. After several rolls, which is a ninja hack, where do we wind up going? Okay, you're asking about exit signals. Well, first off, have your own plan. Outlier is not meant to be a copy trading service. I'm just showing you as a professional investor what I'm doing. These are my exit signals, right? If an outlier sell signal comes through or 1020 cross or an order block is hit or earnings, right? There's lots of reasons to get out. If any one of these happens, that's it. That's it. Nate, how's Chris going to spend his weekend of wintry mix? So I've been hoarding some stim kits. My kids get, what's it called? It's the Mark Rober thing. What are those called? I'm looking at them right now, but I don't see the name of it. What are these called? Crunch Labs. They get the Crunch Labs, but we've been hoarding them for times like this. So they're going to do several stim kits. We've been working on a puzzle, a Stranger Things puzzle. What else are we going to do? There's many books that I've been wanting to read, so this will give me some things to do. I don't want to just sit in front of the TV the whole time. I want to be slightly productive. You were supposed to go to a concert with the Skinwalker Ranch. That was canceled. Oh man, that stinks. Hopefully you got some things to do, my friend Nate. Any progress on a short plan? So we eventually will have short signals. We just don't have it right now, so no stress. You typically target 21 days to entry on an option. But is that really 21 days considering the 7 DTE closure rule? Well, I mean, in theory, yeah. Because we'll just pick KDC at random. Performance summary, let's go over here. Average holding period on this one is 13 days. So, if I have 21 days to start, and then it goes by 14 days, or maybe even 13 days, I'm still out before I have to roll. So the roll is really our get out of jail free card, right? If we can roll out in the future. Of course, you can always go longer. Like on one of these, I'm much longer. One of these I'm in April. Let's go to portfolio view. One of these I'm in April. It's this one here. I'm in April. Yeah, not so bad. By the way, this was a $50,000 account a couple of weeks ago. Just saying. Every single trade has been put on live on YouTube. Just saying. Let's keep going. Okay. Next question. Would looking at the trend across multiple time frames help, or is this already considered in the buy and sell signals? Okay. Of course you want to look at the trend on multiple time frames, right? Now, there is an entire book written on this called Technical Analysis Using Multiple Time Frames by my sworn enemy. Oh, some stuff just fell out of it. By my sworn enemy, Brian Shannon, who sent me a cease and desist order. We used to be cool. Bro sent me a cease and desist order because he claims that, he did get the copyright of Only Price Pays. But give me a freaking break, Brian Shannon. That's like trying to trademark bull market. That's like trying to trademark the word coffee, right? It just irritates the mess out of me. By all means, if that works for you, go for it, right? If you want to align the monthly, the weekly, the daily, the hourly, and the 5-minute chart, that could be honestly, that could be fantastic. It's just not something I look at. And that, for you, it could be fantastic. What is the difference between entry signals for Plan M and ETF? There's quite a lot. In fact, there's so much, so I don't want to spend a lot of time on this. Linked down below is my exact PowerPoint. By all means, go to town. See what you can learn because all of that information is down there. Are you ready for our grid in Texas to fall apart? No. No, I am not. What is the SPY? Why is SPY such an integral part of entry signals? We talked about that. It's because the market rules all, basically. Are there any pros or cons of rolling an option at different points of the day if it's gone over the rolling point? So here's the thing. You can actually roll an option at any time. Anytime. Like legitimately, you put the option on at 10 o'clock, you could roll at 11 o'clock. You could roll again at 12 o'clock. You could roll again at 2 o'clock, right? Doesn't matter. The point here is to have a reason to roll, right? To have a cue to roll. There we go. To have a cue to roll. In this case, my cues start at half ATR, and then at each successive ATR above that, I'll look for another opportunity to roll. But again, you can literally do it not just at any time of the day, but you could do it on the same day, right? But if you don't need to roll it, if there's not any sort of trigger or cue to roll, you don't have to roll. But it's completely up to you. Jamie, what's up, Jamie? After several rolls, a ninja hack. Oh wait, I must not have turned that one off. We're good. Faraz says, hi, Chris. I'm an Outlier member. Well, hey, Faraz, what's up? What platform do you use to select options? Checking gamma, etc. So we have a partnership with Tradier. Tradier actually has a really cool deal. If you go to this site, trade.tradier.com/outlier, and you are already an Outlier customer, and you deposit $3,000 with Tradier, they'll actually give you like $150 in your account or something like that. Double check all the details on this link down below. But this is the exact platform that we are using to compete in the US Investing Championship. And something like Delta is just something you add. In fact, if I go to the settings, might even be something we can add. Let's go to option grid. There's my option grid. This is my settings here, which is exactly what's up here. It's nothing different. Gamma is something you could add. There you go. So if we add gamma on there, maybe I didn't save it. Hold tight. Oh, no, I didn't save it. There is a save button. Option grid. You will, there we go. Add gamma. here, and then hit save layout. Now we'll see gamma show up. There's your gammas. Cool. Actually, I might use that. I might keep that. So that'll show you your gammas, your deltas. So yeah, all kinds of stuff. How do you set up the columns in the Tradier options grid? I just did that. Is there a video that shows how you do that? I just did that. Or you can even just drag them around if you wanted to do it that way too. The Canadian bacon. I'm new. How can I get TradingView with the outlier order blocks? Okay, super easy, easier than you think. So to make your charts look exactly the same as mine, go into the Discord since you already have access, and then go over to the FAQ and member contribution section. Here. Once we're in the FAQ and member contribution section, go to TradingView here. Click that. You want to get the DeepThought indicator. So you're going to click it. It's going to pull up this thing right here. Add it to your favorites. Once you've added it to your favorites and you come over to indicators, it'll be listed as one of your favorites. Now, I already have it enabled on mine. So you come over here, and there are several things that you can modify. I modified the colors a little bit. I actually like to do the EMAs as different items that I can click on and off versus them inside of here, but you can add them right in here as well. So that is how you get your charts to look exactly the same as mine. I am bougie, and so therefore I have the paid plan. I think it's like the middle tier plan because I want to have more than one indicator and I like to cycle them on and off. But I mean, you could use the free TradingView plan with the free indicators that we have in our Discord and have exactly the same setup as I do. Kim Wood, durable goods, not those fragile goods, but the durable goods. How do you get the TradingView ATR overlay? Okay, this is a long question. Okay, multiple questions here. First, to add the TradingView overlay, you need to add an indicator called average true range. Now, if I double click my chart, it shows up down here. This is the average true range. So if you're looking to use the free plan, you can have the DeepThought indicator and the ATR indicator. That'll take up your 2 indicator slots, but then you're good, right? You can see both of those. So that's how you add it on there. Now, how do we use it in position sizing? If you go to the position sizing dashboard, and if you want this spreadsheet linked down below, you can have it. So I'm doing all these hand motions. Link down below, you can have it. Go to the position sizing dashboard tab. Here, put in whatever ticker you want. SoFi, KGC, what else? NEM, Ego. I'm just thinking of trades we put on recently. PPTA, MP, SPY. Right, put whatever you want down there. Now you'll notice some of these will come up red. That's because they are below their 10 EMA. So let's go to one of those. Let's go to SoFi, the world's greatest stock. Oh no, it's actually trending down. If a stock is trending down, we would encourage you not to buy it. So DeepThought, who helped me come up with this, basically zeroes it out and says, don't even think about it, bro. Kim Wood durable goods, don't even think about buying SoFi or SPY. What? Oh my goodness. I mean, the rules still apply to SPY, right? If it's under its 10 EMA, which it is at this very moment, you may not want to buy it because the trend is not working in your direction. Now, how do we use this? So ATR, let me go to a different slide real quick to help explain it. This formula is not mine. This formula came from a $1 billion hedge fund manager. I learned this exact formula directly from Larry Hite, the first $1 billion hedge fund manager, one of the market wizards, and one of my mentors. This is the exact formula for the position size calculator that is shown right here. You get your ATRs, okay, and you say, okay, what is my account balance? Whatever that is. You multiply that by whatever risk percent you're willing to take. Now, this is, we've talked all about this now at our university, but this is something you got to figure out for yourself. I trade at 6%. Don't even think about trading at 6%, because what's going to happen is you're going to take your first loss. You're going to poop your pants because you didn't realize how big 6% is going to feel in the moment. So start with 1%. Figure out how to trade successfully with 1%. Once you have graduated from 1% and you feel comfortable, you can go to 2%. Don't skip from 1 to 5. After you're comfortable at 2%, go to 4. After you're comfortable at 4, go to 5, something like that. But only if you have a proven plan that is working can you size up into it. Size up into it. Don't you dare start big. Don't even think about starting big. You want to size up into it. Then you're going to divide it by 2 times the ATR. Now, why do we do that? That is to normalize the risk. So in this case, you're going to love this. Check this out. So let's say that this is $5 a contract all the way down. Okay. Just for simplicity's sake. If I took this stock here, KGC, just the stock alone with this sizing based on my risk parameters, don't even think about trading my risk parameters. This would result in about 80% of my portfolio in one stock, but I'm only risking in this case 6%. In fact, I want to put this down at 1% for our demonstration here. 256, so it'd actually be 13% of my portfolio. But by using the options like I like to trade, that would actually be only 2% of my portfolio. So if all hell breaks loose, I'm only going to lose 2% rather than 13%. Okay, big difference there. Now, risk per share is multiplying your ATR times 2. So we are normalizing how much risk we're taking per share by ATR times 2. Now I see some of these are kind of bottoming out. So let me go back to 6% here because I want to show you the math behind it. How much risk are we willing to take, honestly, on each one of these? Okay, what is the dollar risk we're willing to take? So if we take the risk per share, which is 2 times the ATR, and then we multiply that by your share size, that gets you a certain dollar amount. Interesting what that certain dollar amount happens to be. 42.62, which is the max account risk per trade. Okay, hang on here. So you're telling me if I take that risk per share, which is the difference between the current price and that risk, whatever that is, $2.78 down, and I bought 1,500 shares, that would be equivalent to, in this case, 6% of my account. Okay. What about the next one? It's the same. 750 times 569 shares would result in the exact same dollar amount. 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 That is the point. We want to normalize risk. Okay? Because first off, we don't have any idea how much money we can make on these. The money is potentially infinite. Okay? We're not focusing on the money. We're focusing in on the risk. By focusing in on the risk, we can keep our risk consistent. So when we go and look at our expectancy, now here's the thing, right? This is what an actual professional investor does. Jack backsides on the internet, right? People who claim to be, trust me, bros, the stock's going to go up. I have no idea what any of this even is. Okay? What we're looking for is we're trying to keep our risk within, and this is not the best example because we've only had wins. We're trying to keep our risk within the ballpark of the backtesting data we had, okay? So if we can get our average loss to be right in line with the backtesting data, and we can let our average win just run out of control, what do you think is going to happen? We contain our losses and we let our winners run as far as they possibly can. It's going to line up and maybe even improve upon the expectancy there. So that is why we focus specifically on risk to start with. Great question. I have time for just a couple more. You guys, it's because of you asking these fantastic questions that so many people are learning and growing their accounts and becoming successful investors. So I want to applaud you for asking these really good questions. Now, listen, I don't have the answers to all the questions. I am not Jesus, right? I am not the Messiah. I am just a random guy on the internet who's been trading for 17 years. And I've seen all kinds of great stuff happen. I've seen all kinds of really bad things happen. And because of that, I love to share my passion. You can probably tell I'm very passionate about this with you. So thank you for making this fantastic. All right, P-Rocks. When the bid and ask spread is 50 cents or less, which is what I prefer, but the open interest is less than 250, you still take the trade after considering your other rules. Okay, so I did this the other day and I did fudge it a little bit. For me, go to that slide here. I want to see 50 cents or less and 250 open interest. But I fudged it the other day. I don't remember what I fudged it on. But it had 208 open interest, but it was still within the 50-cent bid and ask spread. The rule of thumb is that if you are looking to trade, you want to have your open interest be 4 to 6 times or more, at least 4 to 6 times or more, as many contracts as you need. So if you're buying 10 contracts, you want to see 50, 40 to 60 or more, right? At least 40. In that case, right, since it was at 209, I don't even remember. I couldn't tell you what it was, but the receipts are on YouTube. You can figure it out. 209 was plenty. So did I fudge that rule a little bit? Yeah, but I also knew it was plenty of liquidity, so I didn't care. But the 250 is just an easy rule of thumb that you can always remember. Charlotte, an Outlier University Bravo student, says, I'm having problems closing my profitable trades. It's so hard to close when there's a nice green candle. Any tips that personally worked for you? Yes. So, Charlotte, you know the answer. I don't have that. I thought I had that book. Jocko Willenick wrote a book called, in fact, let me double check this. Jocko Discipline book. Discipline equals freedom. Also part of the extreme ownership book, right? Which I do have, which Nana Yule gave to me. So thank you, Nana. Discipline equals freedom. So, Charlotte, discipline equals freedom basically says, in a nutshell, have a plan and stick to it. Once you have a plan and you have, committed to sticking with it, you don't have to think about it. There's nothing else to think about. Now, I'm also going to bring this up, and I know you've seen this before, and I love you, Charlotte. But this applies. I always say you could publish the rules in a newspaper and nobody would follow them. The key is consistency and discipline, right? And the discipline equals freedom comes from if you have your rules and you follow those rules, there is no more mental baggage to go with it. All you're doing is following the plan like a professional would do. If you were going to do brain surgery, Charlotte, right? And this is because I love you, Charlotte. If you're going to do brain surgery and you cut open that person's head and you look around, you're like, man, this is really cool. I kind of don't want to stop. I'm just really enjoying seeing all those wrinkles and blood and all the weird stuff everywhere and brain fluid, right? Listen, Chris could never be a doctor. I would pass out the moment that happened. I'm like woozy even thinking about it. Of course not. No, you would look at this and be like, okay, I need to execute A, B, and C, and I need to close that up and get out as fast as I can to save their life. Think of it that way, right? Execute A, B, and C, do what you need to do and save your portfolio and get out of the way. Because all stocks are bad. Every once in a while they act right. This was a lot of fun today. Thank you all so much for coming. Thank you all for the brilliant questions. You make this better. This is just my community service. The judge sentenced me to community service every Friday morning, and I get to hang out with you and do it. So thank you so much for coming. I hope this was useful. Be sure to sign up for Outlier. It's 82 cents a day. Give me a freaking break. And if you're ready to save time, make money, start winning with less risk, click one of these two videos. We'll talk soon.